Yahoo Finance's Morning Brief. I'm Julie Hyman. Miles Eldon's over there. It's Friday. Come on, man.
It is Friday. It's only your second day here this week.
That's true.
You've got a little shot of life plus.
Yes.
Plus, you're going away next week. So
That's
you're
true.
on a high right now.
I am on a high, despite the fact that the markets have finally realized, hey, there's a war going on and oil is spiking.
That's where I'm at. So, all right. So on this point, on the market point, where we're going to saw the Nasdaq closing correction yesterday. Futures lower today. We sat here on Monday talking about how the S&P 500 had taken out its 200-day moving average last Friday. We're now below that again. I'm very hot right now on this idea that price leads narrative. And I think we can go through every detail of like the latest back and forth on the Iran war. But something that we haven't talked about at all, I don't think, in the whole month we've been doing this, is the VIX. And that's a very in the weeds kind of market indicator. It's essentially an indication of how volatile the market, how volatile traders expect the market to be going forward.
Right.
And the VIX right now is around 28. It had been in the mid-teens ahead of this conflict, but if you kind of go back over 6 months, and especially the last month now, kind of just grinding higher, floating higher. And to me, it just is starting to look like this is a very different overall market regime and that it's not going to be saved by a headline. And 2022 is starting to feel very analogous to me, feeling like a parallel. You have a number of different factors that appear disconnected and may actually be disconnected, but when you bring it back to the stock market and on the margins, why am I excited about something? Why am I coming in to be a buyer, to get bullish, to not choose this moment to kind of soften those, create padding around my portfolio, whether that means selling stuff, yada, yada, yada. It just doesn't look good right now. We're squaring up the end of the first quarter, and there's just not a lot of things right now that feel like they're ready to reverse. Like negative trends do not feel like they're ready to reverse.
So a couple things on this. First of all, what's interesting, your observation about the VIX, about it like steadily grinding higher, is the VIX doesn't always do that, right? What the VIX tends to do is spike, and then come back down. So it's a little bit unusual. It did do it in 2022, where it was more of like a steady move, for what it's worth, to kind of prove your point. The other thing is, like, if you were going to pad, where would you go? So I was looking at the stats for since the month to date or since the war began, which is the same thing. The S&P 500 down 5.8%. The 10-year yield is up 47 basis points.
Yeah.
WTI.
Which means, to just stay there for a second, that means that if you own bonds, you're getting crushed.
Yes.
So this is like part of the problem. Okay, continue.
Yes, exactly. And a lot of people gotten into bonds with the anticipation that rates were going to get cut, right?
Right, that rates were going to go lower, so the value of your bond goes higher. So now you see the opposite, yes.
Now you're seeing the opposite. WTI 41% as of the time I looked this morning. Brent 49% up, right? So I guess you could get into oil if you still thought.
Yeah.
Gold down almost 17%. Bitcoin's up about 5% now, but there's been a lot of volatility in that. And if you were looking at the MSCI World Index of stocks, excluding the US, it's down 9.8%. So this has been like part of the question of, okay, if you're looking for padding, if you're looking for safety, or you're looking for hedging, like it's the same if you look within the S&P 500 during this period, the only thing that's up is energy stocks. So if you were going to somehow position yourself, it's been tricky to, at least in the present time, find something that is not, unless you're looking at oil itself.
Yeah.
So it's tough to avoid risk right now.
Well, I think that overview is why the vibes are terrible.
Yeah.
The vibes stink, and I guess I kind of come into the end of this week, and again, looking at the end of the quarter and trying to look at earnings seasons right around the corner, right? We're going to get into bank earnings in 2 weeks here, and just figure like, what am I supposed to be excited about again? And not that the market is always supposed to excite me or entice me, but just putting myself in the mind of either an investment professional or someone who's in the general public just looking at the stock market.
Yeah.
It's like, what is out there right now? I mean, I wrote down what you outlined. So stocks are down, bonds are getting killed, oil, which is not like, you don't buy oil in the portfolio. That's not a thing, right? That's not something, like a retirement account doesn't just have oil lying around.
Yeah.
So that's out the window. It does have gold, that's getting killed.
Yeah.
It does have international stocks. Everyone came on the shows end of 2025. Oh, international, big year for it. Down even more than US stocks. So there's nothing working right now.
I will say, I was struck, I was like going through my inbox this morning looking at strategist notes. then people see, like, there is this dissonance still.
This is the other thing that's kind of a little craw in my crick in my craw here.
Torsten Slok over at Apollo writes this morning, markets are overreacting to what will likely be a 4 to 6 week period of volatility, which will ultimately result in 50 years of stability in oil markets, supply chains, and geopolitics. Think about all of the things that need to go right for that to be true. It could be true, great.
It could be
maybe
true.
It's true in the long term. I look at, Keith Lerner, who says equity risk reward is incrementally improving.
Yeah, he's like, he's looking for buying
cash
here.
deployment is warranted. Chris Harvey at CIBC, he says, we've been cautious. However, we now see double-digit upside to our year-end S&P price target of 74.50.
All right, so you know what I think? You know what I think the thing is with, and we'll pick on Torsten's note here, because I'm reading it now.
Yeah.
The bottom line, the Iran shock not big enough to offset strong tailwinds from U.S. economy, AI spending, industrial renaissance, and the one big beautiful bill. I guess the thing is, back to my point of this price leading narrative, it's not obvious that these things, AI spending and industrial renaissance, one big beautiful bill, the AI revolution, it's not obvious that markets coming into the Iran conflict had been convinced of that direction. We would have sat here 2 months ago, and the big narrative at that time, kind of early February, was, well, it's so weird. The stock market, the S&P 500 is flat, and you have all of these names underneath the surface that are down 20, 30, 40%. What a strange market. And indeed, that is a strange market. And it's not that there's a rule that the market has to resolve with either of those names rallying or the index coming down, but it appears that it has indeed started to resolve with the index coming down to meet some of those names. And there was information in a stock like a Microsoft, which I know we want to talk about, being down 30% so far this year. The Mag 7 trade completely not working. Looks like that was meaningful on an index level, right? And it was an oddity for some period of time. But I guess that's the other thing here that just is struggling to be like, what's the theme of the week? I think the theme of the week is that so many things that are taken for granted, which I think is kind of like AI, infrastructure as investment. It's like, I don't think investors have as much faith in that actually working out as was assumed a couple months ago, certainly a year ago.
Well, and to your point, what was so interesting about that mid-February time period is that most of the people we were talking with were bullish, right? They were saying...
Still bullish.
They're still bullish.
Yeah.
The fundamental earnings case is good. I think Mike Wilson said that earlier this week of Morgan Stanley, that the profit outlook is still good. Okay, great. So the profit outlook might be still good for some companies, but is it good enough to justify shrugging off a huge geopolitical shock? And even absent that geopolitical shock, is it good enough to justify the prices where they are, right?
Yeah.
So I guess that's the question that people are asking. The other thing that Torsten says is sentiment destruction, not demand destruction. That's the title of his note. And he's sort of picking on this continuing idea that even if people feel bad, they're still spending. I guess, but I don't know how long that, yes, we've seen that pretty consistently in the past, and I know we're going to get into like wealth inequality at some point in the conversation, but it comes back to the question of, is wealth inequality eventually a problem for the U.S. economy? Is it eventually a problem for the markets? Are we there? I don't know, but it's like, I think it's not something you can ignore.
All right, can I do a last one here, and then we'll move on to, maybe we can do that one next. The other part about the earnings point around, earnings aren't going to go down, so the fundamentals are good. Earnings basically don't go down. It's like not really, like it happened in the financial crisis.
Right.
It's not really a thing that happens, particularly in the modern American class of managers knows that the number one thing you don't let happen in your business is earnings go down. So we've talked about layoffs that are happening at a variety of companies. Is it about AI? Maybe, but it's certainly about the bottom line. It's certainly like, hey, we would like the EBITDA profile to look a certain way. Easiest way to do that, cut your personnel costs. This is not rocket science. So what the market is saying, as you mentioned, we want to pay less for $1 of those earnings. When interest rates go up, the preference to buy an earning, a dollar of earnings from a corporate on the equity side, that goes down, right? Stocks tend to go lower when rates go higher, which you outlined in the beginning. But it also just comes to this idea of, I guess maybe it'll end up being fine, and I'm the stocks usually go up guy, but there's just something about don't you guys know earnings are fine while the market is just bleeding out every day and the tape looks like an absolute disaster, that to me, I'm like, I don't care. Obviously, no one else cares either. Obviously that's not the message that's going to get through. And we'll see. Maybe this is window dressing on Q1. Maybe we'll just get it out of our system for March. But the market is just acting terribly. There's just no other way to say it. And it doesn't mean it goes down 1% every day, but this slow bleed of you wake up on a Wednesday, software stocks down 7% again. It's this is just not a strong environment.
Well, one more final point on this to take this a little bit of the other side. When Torsten says markets are overreacting to a 4 to 6 week period of volatility, and when you say stocks go up, right? Next year, maybe stocks will go up. In other words, at some point,
of course,
the period of volatility will end.
Because I just said earnings don't go down.
Right, and things will resume. It's just a question of is it going to be longer and create more economic damage than is sort of being realized right now. Yeah. So I guess that's the big question.
All right. Other weekly things. You want to do a little private credit here? Speaking of,
we can do a little private credit.
Okay.
Private credit is
so we didn't.
TLDR, private credit is terrible.
So we didn't talk. We talked off camera about this idea of the strategy of these various private credit vehicles, the funds. So almost all of them have the same essential structure, which is we will redeem 5%, up to 5% of the value of the fund on a quarterly basis. So the main story right now is that these vehicles are getting capital calls for more than the 5%. This doesn't mean and Apollo's fund, when they came out, I think it was on Tuesday night, it's their net inflows were 700 some odd million, their outflows were about the same. So basically the amount of capital within the structure was static, so there wasn't a huge amount of capital coming out. But they're getting calls for more, and the funds are saying, we will redeem at 5%. We will follow our rules. Thank you. And
some of them are bending the rules.
Most of them are at the 5, right?
To the rules.
And I think to me, it's a very interesting, it's no longer an investment decision, really. It's kind of like a strategic business development decision of how do you want to run this thing? And I'm just curious if you've thought about, if you were running a BDC, how you would approach the 5%. I get 11% redemption, but my rules say 5. How would you think about going forward?
I mean, I don't think that I think they kind of have to stick to their rules, right? That's what we talked about this too. It's sort of the whole premise of the way that you do this is you hand your money to these people and you say, I trust you.
You're smarter than me.
You do this with my money for a certain period of time. So they risk, if you see a wave of, okay, we'll give you 10% instead of the 5%, oh, is there a real problem here? Then you risk sort of a sentiment cascade, right? So, that said, the chatter around this the tenor has changed a little bit. I've seen some admissions reportedly from some of the executives, maybe retail investors didn't understand it as well as they should have. Yeah. You see talk about, okay, maybe there are, inevitably, if you're gonna lend money, some percentage of those loans is gonna be bad. Right? It's just how it works.
Yep.
So I guess the question is now, is there a higher percentage? Is there a growing percentage? Is there something really? And it doesn't, listen, I haven't dug into these things deeply, but it doesn't seem like that there is some huge percentage of these things that's going bad. Is it something that's ticking up because the economy is in a different part of the cycle? Maybe. But it's so opaque, it's difficult to know if that's what's going on.
Well, and part of the design is that you don't have to know what's going on.
Right.
Even the firms, the sponsors of these, who are of these BDCs, are the explicit pitch is that our investors don't have to get weekly, even monthly marks from the loans. We have a view on this business, and it's going to be a multi-year cycle. I think I'm 85% on board with the idea that stick to the rules, 5%, prospectus exists for a reason, let's just stick to our guns, ride this out, people will come around. I am interested in the concept, though, that which you raised, of maybe retail investors. And to be clear, it's not necessarily just us going on a brokerage platform and buying. It's an individual who's not super high net worth, who works with an RIA, who has this recommended. That's essentially a retail investor in a way. It's not an institution, it's a person.
Right.
That they didn't know what they were buying. I am open to the idea that it might just be better, and I think about this in a business strategic sense of we've got a bad customer, we've got bad investors, let's just get them out of here. Let's turn it over, because the rules while they're safer and they exist for a reason, and I do think just the structure of like, we don't want to create a run on the bank, let's say, by allowing increased redemptions.
Yeah.
There is a part of me that says like, you have a group of your customers, a group of the folks you're working with who are telling you that for whatever reason, they're not on board. Sometimes it's just better to clear it out.
The problem is it's not just the bad customers. The whole premise of growth of these companies over the past few years has been tapping into the retail market.
But then you'll find better customers. You'll find better ones. You'll find someone who says, you know what? That's interesting. I hadn't really looked at this as closely. I actually am on board. I'm going to increase my allocation now. I think that's a possible.
I don't know if you just risk abandoning the muddying the channel entirely. I don't know.
Well, I think the bias is you do, right? That's the majority case. I'm just trying to go through like what the strategy would be around like it's rare that a business has customers who sort of announce themselves as saying, I'm not happy with your service. And it's rare that that business kind of has the opportunity to say, great, take your business elsewhere.
Yeah.
Here's your money.
Well, the other question is, can they afford to do that? Which is a separate question.
It's a separate question. I do think if you look at the way these are capitalized, I mean, yeah.
Probably.
The answer is yes.
Yeah,
these firms have enough capital to make these things work right now.
Yeah.
So, at any rate, again, 85%, I would just stick with it,
right.
But yeah, I'm open to the idea.
I mean, underlying it, so to go back kind of to what you were talking about at the top, the other thing that's interesting about private credit doesn't have to do with private credit itself, it has to do with what they're investing in, right? So, which we've talked a little bit about. So kind of circling back to-
software company, John Zito said.
Yeah, exactly. Circling back to like the fact that like if the Mag 7 have done that bad, imagine what, right? Yeah, exactly. Imagine what Joe Software has done.
Yeah, exactly.
You know, if Microsoft is having its worst first quarter or something
2008.
Since 2008, what is Joe Software doing?
Yep.
Right. So I think that is really the big question here. You know, and Microsoft will come back, right? Microsoft is Microsoft, I think. We can. I mean, I'm scared to make declarative statements.
I don't have a view on the stock. I just know it was dead money for 15 years.
Okay,
before
that's fair.
Satya did
That's
one of the
fair.
great executive jobs of all time, bringing it to this level. But
I guess what I'm saying is, you know, if the outlook for Microsoft will survive in some form. It's
absolutely.
not going away.
Of course, yes.
That we can say.
Set a baseline. It will be a company.
But the you know for even a you know. Even a Salesforce, like, well, I don't know what the future of these software companies is. Are they going to go away? Probably not. But like, what do they look like? I don't know. And I think that's still, even though we're all distracted by geopolitical risk right now,
I'm not.
That question hasn't gone away.
No, and because the thing is, it's. You know, what does the textbook teach you? The textbook teaches you that all these businesses are the discounted value of their terminal. When they go out of business, what cash is left and what do you get as an investor? Discounted back to the present. So really, in a way, every bet on a company is a bet on what does it look like in its end state.
Yeah.
And why you've seen all these valuations come down, like to pick on a Salesforce, for instance, it's like, well, the end state, the terminal multiple of Salesforce in the market's view right now is a little bit lower than it was previously. Yeah. That has nothing to do about the business's going concern status in the near term. It's just simply like, I was paying X for Salesforce's future cash flows, which are going to be enormous. I'd rather pay Y. Y is a little bit less than X right now.
All right, we better get to the rich stuff.
And have a little bit of fun before the weekend.
Yeah,
I'm a little grumpy, so let's on a high note here.
So earlier, I think this crossed before I got back this week. I reported in the Wall Street Journal. There are about 430,000 U.S. households worth $30 million or more. They're pulling from Federal Reserve data that was analyzed by a company called Zidar. 74,000 are worth $100 million or more. Mm-hmm. And then at the same time, David French, who's a New York Times columnist, he writes in a piece, we're constantly reminded that America is a multi-tiered society in which a high income buys you a very visible degree of prosperity and a decent income gives you nothing special at all. There are so many high income Americans that the entire economy is warping to accommodate the minority at the expense of the majority. So this goes back to that like two-tiered economy. It's, you know, and just the impossibility of why are you smiling at me in this way? Well, you know, just this, like whether it's social media, whether it's, you know, just conspicuous consumption in general. Something I've been thinking about is that like when you look at CPI, it doesn't really capture.
Yeah.
When we're looking at those numbers, that doesn't really capture
Yeah.
how much it costs to live in this country right now.
So
at a certain
yeah.
level.
So I have another like bugaboo that I have. It's not even a bugaboo. Just this idea that I've been working through is like the percentages versus the gross dollar amount, basically. To your point about CPI, and there was a story in the Times over last weekend, and they do these all the time, like the rage bait, like, this family in New York City, I think it was on the Upper West Side, makes $500K a year, and here's how they have no money or something like this, right?
But did you know they were sorry. Sorry. Go ahead.
Well, it's just that like there's so many people, to the stats in the journal, to David French's point, so many people who make very large nominal dollar amounts. It's like this amount of money that I think of as I was told there would be money amount, because when you're in high school or you're in college, and you first start to you make $10 an hour at your first job, and you realize like what that looks like in the paycheck. You're like, oh my gosh, someone who makes $200K a year, they must just be swimming in it. And then that person goes on and they make $200K a year. They're like, where'd all the money go? I thought there was going to be money here. So I think it just is about this squaring of the percentages of like, okay, well, inflation's fine because your rent only went up 2% a year. And it's like, okay, but 2% on $4,000 is a lot. It's $800. So all of a sudden, you're thinking like there's no nominal dollars left. And to your point, the stats will say, but the percentage, the cost of the energy intensity within the household budget is so much lower. It's like, yes, but when I went to the gas station on Monday afternoon, it was $80 to fill my car. And I never look at the price, and I was like, wow, that's quite a bit of money.
Yeah.
And I think that it's just the numbers, the raw dollars just got so big that people are just like, I cannot believe how little I'm getting for what is, to the point of the journal article, an exorbitant amount of money that so many people are making. Even people who make, who think they're middle class and they make $250,000 a year, that is so much money. But the nominal dollars that come out of that, because the nominal dollars, spending $18 salad I'm going to get today, like all this stuff is just so offensive.
So there's all that stuff, right? There's the $18 salad, there's the $80 gas tank. As David French points out, the price of youth sports. Your kids are too small, but just you wait, my friend. Wait until they're playing sports.
I have no problem finding ways for my kids to send money out the door.
Exactly. The price for, I know you drove to Ohio. I'm about to go away. The price for a family of 4 to fly anywhere, even domestically, doesn't matter. Forget about it. Like then you add hotel or you add Airbnb.
$2,000, right?
Like it's nuts, and it doesn't feel like that is captured in what the Fed is measuring or what economists are looking at, and it's part of the reason. This is a whole other topic. We'll get into more of it.
Well, the vibes stink right now, Julie. That's why the vibes are terrible.
Stink.
The vibes stink. All right.
It is Friday. Everybody have a great weekend.
Everyone enjoy their audiobooks over the weekend. I'm enjoying mine. All right.
Brian Sossy's next opening bid.
It's Friday for the stock market. I'm Yahoo Finance Executive Editor Brian Sozzi, coming to you live from our New York City headquarters. It has been a week for the markets and humans more broadly, that much is for sure. Here's what's on my mind right now. About $100 billion of Meta's market cap went up in smoke on Thursday after an unfavorable jury ruling against the platform. The fact we aren't seeing buyers aggressively buy this dip, I think, says a lot on fresh concerns on Meta's near-term fundamentals. That's just one guy's view. It's my view. Sticking with tech, a new chart from Truist CIO Keith Lerner, a friend of the show, is really lighting up my exit count this morning. Tech stock valuations are back to the lows seen around the April 2025 tariff shock. The ultimate buy signal? Who the hell knows? Doesn't hurt tech is cheaper for a change, though. I should note that. And another chart that I put on X that is feeding the social media beast, so to speak, is one from the Bernstein team. It shows restaurant industry sales on the decline throughout February as the war in Iran has sent gas prices surging. Tough to see not even the viral big arch being able to save this industry. Hate to see it. Here in the Open Bin Roundtable, Thomas Hayes, Great Hill Capital Chairman and Managing Member, Michelle Schneider, MarketGauge.com Chief Strategist, and Brooke DePalma is here in the house. Good to see you all. Brooke, I'm going to start with you. It's a little bit of a random Friday here. You heard what I said on that data for the restaurant industry. Like, this was really yet another sign you and I have been talking about all week long. Signs that the consumer is really starting to come under pressure from these gas prices. The stock market may not care about it, but maybe they should be caring about it.
Brian, also don't forget that this winter has been marked as one of the worst that we've seen in years. So many franchise operators that I spoke with said that those winter storms that we got really took a toll on consumers coming out to spend, even though we heard from Walmart that they were willing to online shop and deliver more. But definitely all these different factors, higher energy prices, it's the fear that they're going to pay more at the pump. And on top of that, too, just seeking out, okay, where am I going to budget this month definitely has taken a toll on consumer spending. But similar to what we heard from Bank of America, consumers are still going out, similar to Walmart. They're going out for electronics. They're buying on restaurants, and they're also buying on clothes as well. And so consumers are really still picky and choosy, similar to what we heard last year. And it seems like that's continuing into 2026.
Tom, all week long, it's good to see you as always, my friend. All week long, I've heard so much optimism. Various Wall Street firms coming out, maintaining their S&P 500 targets, outlooks for strong double-digit earnings growth. I even had Nora Robini, a.k.a. Dr. Doom, the economist on my show, and he sounded upbeat. Where can you hit me with a little bearishness? I mean, there are concerns out there.
There's no question there are concerns, but what people say and what people do are two different things. And what we saw last week was record put buying. If you look at put skew, the amount of people that were buying insurance on a house that was already on fire was unlimited. I mean, we have to go back to the lows in 2022 and then the lows in COVID. And what happens when everyone buys insurance after the house is on fire? I'll give you one guess. They don't get paid out, okay? The people who get paid out are the dealers who sold them all that insurance. So what does that imply from a technical standpoint for the market? It implies one of two things. Number one, you grind sideways, and all the people that bought that put protection after the correction wind up with nothing at the end of expiry. Or two, which is usually the case when everyone gets short in the hole. We saw record selling volume on Friday, which was the lows, which we're retesting today, is that you get a rip your face off rally, okay? And if you look at the underlying economy, whether it's earnings growth, okay, we're expected to have 12% earnings growth in Q1. We're still expected to have 15% earnings growth in 2027. Now, if this goes on for many, many, many more weeks or a few months, those estimates are going to come down. But while all this has been happening, Brian, estimates continue to go up because the underlying economy is still strong. And as it relates to energy, people's base case is this is a short-term shock. If you look back to the Obama administration, the economy recovered very nicely with $90 to $100 oil. I don't think we're going to have persistently high oil. So as that comes down, that's going to help consumer sentiment, et cetera. But to Brooke's point, yeah, in the short term, consumer sentiment is weak. We see all the sentiment numbers, and they're going to need to absolutely turn that around if President Trump and his party want to have any strength in the election. They're going to have to pay attention to that, and that's why the reports of him wanting to end this thing quickly are probably very accurate.
Michelle, good to see you as always. Also, yesterday's session was awful. I mean, it was just a terrible session really across the board. Anything you're seeing, I know you watch a lot of technical indicators, anything you're seeing that would suggest that we will get that rip your face off rally that Tom mentioned?
Well, really, to put context on both what Brooke and Tom said, if you look at the chart, what is so interesting is the consumer, and I like to look at XRT as my ETF because of its blend of staples and discretionary, has broken down. It's under the 50-week moving average. It's under the 200-day moving average. And it looks like any rally that it's had so far has been met with extreme selling. On the flip side, the Russell 2000 is above the 200-day moving average and also above the 50-week. So is transportation, which is really, I think, the most interesting because, of course, you would think that that would be the most impacted by these rising energy prices. So we're in this kind of war between what's happening in the manufacturing sector of the U.S. and the small caps versus what's happening with the consumer. And I really think, as somebody who's been doing this for a long time, it's hard to make any commitment until that resolves. Will the shorts be right? To Tom's point about the put buyers, well, obviously, if IWM breaks down, I think they'll have their day in the sun. However, if it doesn't, then that will drag everything up with it. And of course, that's your rip your face off rally.
Michelle, let me stay with you here because we saw a really large drawdown yesterday in Facebook or Meta. I mean, $100 billion in market cap, totally up in smoke. Stock plunged, not seeing a lot of buying here today. What do you think that chart says, and what has to happen for Meta to regain some of those moving averages?
Well, first of all, this is the third time we've seen this massive crash over the last decade with Meta. 2018, it happened. 2022, it happened again when earnings missed. And there was a lot of scandals going on about just faith in its programming. And now, of course, here we are in 2026 with its major legal problems. So, trying to buy a falling knife obviously would not make any sense. But it does look like it has one chance if it holds the 2025 lows, which is around 480 to 500. We're not that far away. And we get some kind of a buying coming in at that point with a good accumulation day off the lows, then maybe the worst of it is over. I mean, one thing we cannot dismiss is Mark Zuckerberg has been incredibly experimental. Obviously, with Metaverse, it didn't work out so great, but he is really made a lot of money, put a lot of money into AI, and I wouldn't necessarily dismiss him forever.
Yeah, Metaverse was real trash. I mean, they just wasted a lot of money on that. But I think we got some polymarket odds here. Polymarket trying to figure out what may or may not happen to Meta stock. You can see some of the predictions there on the screen. Brooke, let me go over to you here because we did see the sell-off in Meta, but it's really in the context of a broader sell-off in all things Mag 7. This has not been a good week for these 7 stocks.
Certainly not a good week for Mag 7. And also when you take into consideration that trial and that lawsuit, you also have to look at Google as well. And despite what we saw this week with the sell-off, we are still seeing or hearing some optimism on the street when it comes to Google, even though today it's still down about 1.7% as we make our way into today's trading session. Laura Martin started saying that despite the odds of this case, it's sort of not over until it's officially over. She also went on to say that the amount of users that are actually under the age of 18 only make up a small percent of YouTube. But when you think about at large just how many people are on the platform and how much revenue that Google relies on YouTube for, it could have broader implications, and or it might just be a minor blimp given that younger user base is not as prominent as maybe older user bases that this lawsuit did not apply to. But on top of that too, you can't help but think about another name within that same sort of sector that has largely been compared to it, and that's Netflix. And Netflix this week also announced that they were going to raise prices for consumers. And so there's so many different puts and takes that I feel like investors are trying to understand and digest right now as we make our way into the year. But certainly Google having some moat here to move past this.
Tom, I think part of the sell-off in Meta reflects, of course, that the jury ruling, but I think a lot of people use that news to go back and crunch numbers on Meta, and they realized, or they remembered, that they're spending billions and billions of dollars on CapEx, and this could be a year of margin pressure for this company. Are you a buyer of Meta here on the pullback?
No, not a buyer here. And I do think tech, and believe it or not, I think software is probably due for a knee-jerk bounce. But to your point, CapEx as a percentage of operating cash flow is exceeding 90% this year for Mag 7. So, until we start to see a return on invested capital for those investments, which is probably a year and a half, 2 years off, I think any relief rally is going to be sold, and institutions are going to, particularly in software, if we get a violent relief rally, I think institutions that were trapped, that didn't see it coming, are going to use that to get out. And I think you're going to be able to find tech and software at much better prices probably later in the year, fall time frame before the election. So you got to watch that. You got to watch that CapEx. You got to watch the return on invested capital. And I don't think we're going to get those answers in 2026. I think we're going to start to see some positive green shoots in 2027 for those.
Michelle, what are one of your favorite charts in the market right now you're watching, and why are you watching it?
Well, outside of energy, or are we including energy?
Whatever you want. We got options. We can oscillators. Toss them at me. Whatever you got.
Well, obviously, we have to look at oil and gas first. And I think we need to put that subject to bed, because we got to get through $100 a barrel in order to see higher oil prices at this point. Again, price dictating the narrative. It stops short of 100 several times. And I'm looking not at Brent. Obviously, I'm looking at WTI. And then with natural gas, I'm so perplexed by that. So I really believe that this hold that it's had around 280, 290, now it's back over $3, is probably a good buy opportunity for many reasons we don't get into. But if we go outside of the energy space, the trickle effect, of course, would be food prices. And if we're looking at something like DBA, which is a good aggregate of a lot of soft commodities and agricultural commodities, that's had a pretty major breakout. So really what you have to ask yourself right now is, at what point does all of this food rising, fertilizer rising, energy rising, does that stop? And then you have all these great opportunities on things that have been really, really cheap. I mean, we're looking at things, believe it or not, I still love the vanity trade. And now we may have a really good opportunity to get back into some of the stocks related to that if things calm down. Novo Nordisk, they just had an FDA approval on insulin, by the way. Looking at even Ulta Beauty, that stock was at 700. Now it's getting close to 500. That seems to me like, even if we go recession, it's probably a good trade. So yeah, I think you got to watch the food, the energy, and before we get too excited about anything, see what happens there.
Yeah, I'm glad you called out Ulta. I just had a great conversation with Ulta CEO Keisha Steelman. Podcast is coming soon, but I think what they're doing in terms of product innovation and the speed in which they can move is absolutely mind-blowing. Brooke, last word to you. One of those restaurant stocks that are still doing well, believe it or not, during the sell-off, it's Restaurant Brands, parent company of Burger King. I'm surprised, because Burger King is, look, it ain't my fave, but I know they had that viral ad. I get it, sort of.
I mean, Burger King has been innovating. It's been building out. It's been ramping up. New leadership there is sort of trying to push the momentum forward to get consumers back in the door. And so I'm not too surprised to hear that. I feel like in this sort of environment, we hear a lot about consumers turning to value, even though they have been pulling back a bit. But not too surprised to hear that, but definitely interesting. I mean, there's no chicken sandwich that's going to boost Popeyes like it did a few years ago. So we'll have to keep a lookout for that. But Burger King CEO did have a good video to push back a little bit and have some fun with us. Well, McDonald's CEO Chris Kempczinski.
Full disclosure, just not a Whopper guy, and I will never be one. Big thanks to the Opening Bid Roundtable. Good to see you all. Have a wonderful weekend. All right, for more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. I head there first each day to get the pulse of what could be hot in the markets, and you should do it too, just like me. Straight ahead, I square up with the CEO of Bare Knuckle Boxing. Don't go anywhere. I've been taking a tour of the world of sports the past few weeks here on Opening Bid. I've welcomed on NASCAR star Joey Logano, Formula One CEO Stefano Domenicali, and Mercedes-Benz CEO Ola Kalianis. All of these chats have reinforced to me that the business of sports continues to absolutely thrive. Today I'm driving off the road and entering the cage. From the sold-out spectacle of Knuckle Mania 6 in Philadelphia to the groundbreaking launch of the Bare Knuckle Fight Club Tournament Series, my next guest is helping to move hardcore combat sports from the underground to the mainstream. David Tatro is Bare Knuckle Boxing CEO and Lights Out Productions president. Good to see you here. This is
Thank you.
This is quite the thing to watch.
Oh, it's just amazing. I mean, it's got that gladiatorial nature to it, and that visceral offering brings in fans, you know, male and female. They just love it.
That's very elegantly put. So you just passed your 1 year mark, or coming up on 1 year?
I'll be coming up on a year as CEO in June. I came on after serving as president of Triller for a number of years, and while I was there, got involved with our competitor in Bare Knuckle. And I came over just this past June. Mike Vasquez was looking for a CEO. He's built the company as the chairman and owner since 2014. And he wanted to take it to new heights, and we're building it into, you know, that league, which is really going to deliver.
What did you see that made you want to join the operation at that particular time?
What I saw a really great owner in Mike Vasquez, with a pedigree having launched NASCAR Mexico, and a deep understanding of really what was driving the audiences. You know, he started this with Dada 5000 in South Florida. They were really the ones that brought the authentic nature of what Bare Knuckle is with their backyard brawls. And I saw that he had made a significant investment in the UK, acquiring BKB, which was Bare Knuckle Boxing in the UK, combined his US operations with the UK operations, had a roster of about 200 fighters at that point. I knew he was very serious, and with that, it gave me the confidence to join him and really kind of work on building this into the media engine that it needs to be.
Well, how are you building? How many events will you have this year? What is the content component to this?
Sure.
And how much does this cost to even go see a fight?
Well, our ticket prices range anywhere between, say, $150 and $200. You know, that's kind of our ticket price at the moment. We do about 22 events a year, okay? So wow. we do a numbered series, which are our championship and our contender series, which we have one tomorrow night at Foxwoods. Real big event there. It'll broadcast on Vice at 8 p.m. Eastern and Telemundo, 8 p.m. Eastern in Spanish. So we're English and Spanish with dual distribution windows, which is great. We have Cub Hawkins taking on Jesse Ronson, which is going to be an unbelievable barn burner. But back to your question, we do 22 events a year. 16 of them are numbered events, and then we just started a new activation series with Bally's and the whole Soo Kim enterprise. And with that, we're doing what we call a 360. So we're on his platforms in English and Spanish on Bally's Live. We're in his casinos around the world, and that includes casinos here in the US as well as some casinos in the UK and in Australia. And then we're utilizing his technology. With this technology, we're integrating sensors into the wrist wraps so that we're able to track punches, create fan engagement, create opportunities for betting, and also new ways of doing storytelling, right? With new graphic pop-ups that kind of showcase damage in, damage out, and overall it all culminates.
It all looks damaging to me. Like, I'm gonna be honest with you, I watch this on YouTube. It's like a 2-hour drop I watch it, and 30 minutes in, I'm like, I feel pain in my face, and obviously I'm not in the ring. I mean, this is a hardcore sport.
It is a hardcore sport, you know, and we just came off doing an incredible documentary with BBC. We partnered with them. Eddie Hearn was part of it on the boxing side. I was the spokesperson on the bare knuckle side. And it was a very fair and balanced look at bare knuckle and the rise of bare knuckle. And when you really take a look at the sport, while it does have brutality in it, a lot of those are lacerations, right? And the accumulation of punches in boxing versus what goes on in bare knuckle is a completely different type of sport. Our fights are faster. There's less rounds.
Just getting hit in the face.
But our concussions are way down.
Okay, that's good.
And that's that's a proven fact.
You've won over lawmakers, right? It's taken a long time. I think of the road what UFC had to go through. Like, how has it been hard to convince the lawmakers to let these things happen in their states?
You know, it hasn't been as difficult as you would think, and the reason why is Dana White really, he took that on years ago, and with the UFC and the way that he's grown the UFC and all of the medical requirements and all of the regulation behind that, we're able to kind of jump on and follow on that and utilize a lot of what he put in place. So we're cleared in close to 40 states around the country.
What does a fighter typically make? I'm sure you've seen the what UFC has been going through in terms of fighter pay. I mean, What do your fighters make?
Well, I can't disclose exactly what they make, but we are paying significant, purses to fighters across all of spectrums. You know, whether they are, our up-and-coming prospects, our contenders, or our champions. You're able to see very, very good paydays for them. And that's evidenced by the fact that we recently signed Victor Ortiz, a former boxer. We signed Lee Selby, and we also recently signed John Molina Jr. You know, so with those signings, the money that we're paying is good enough to get them to come and enter the Trigon.
To achieve the vision you and your founder have put forth, are you out there raising money? Like, what's the valuation of this business now?
Well, right now we're not in the money raise phase. It's all been funded by our owner, Mike Vasquez. At the right time, if it's necessary, we will go into the market and we will do a raise. But what we're really doing right now is we're building a broadcast-ready product, and the fact that we're on Vice, we're on Telemundo, we're on Bally's Live, we're on Estrella, all of that gives us the opportunity as we're growing, and to pivot into other deals, additional series with streaming partners, with broadcast networks. And if it's necessary, we'll go into the market and we'll raise money, but we're not in that place right now. We have a very, very small cap table. Mm-hmm. We're in a very, very good financial position.
How do you explain the fascination and the love for combat sports?
It's visceral, right? And that's the whole thing. Whether it's boxing, and I have a long pedigree in boxing, having been the chief business officer at Golden Boy and part of some of the greatest fights in the history of
Oscar
boxing.
De La Hoya.
With Oscar De La Hoya. So I've seen that angle of it. I've seen everything that Dana's done with UFC, and it really comes down to kind of that whole visceral offering. And if you look at any of the emerging leagues that are out there, they're creating sports that have a visceral offering. They're easy to understand. They attract males and females. And that's the biggest thing with combat sports, and in particular with bare knuckle boxing. And we really emphasize boxing. It's because there's some significant skill that goes into what our fighters are doing. That's the nature of what drives this. Whether you're a male or a female, you are driven to the idea of two individuals getting into the ring, ready to square off without any gloves.
I was thinking coming in here, Dave, anybody that comes on my program and makes a horrible stock call, I should send them to y'all, put them in the ring, and they could be used as punching bags. I mean, I'll be honest, but anyway, go check this out. Good luck with the event this weekend. That was good
thank
stuff.
you so much.
Look forward to continuing to follow your progress. All right, save the date. Monday, a new episode of my Opening Bid Unfiltered podcast drops at 8 a.m. I sit down with Blackish creator Kenya Barris and Revolt CEO Datavio Samuels to get insight into the future of media. From their perspective, there's way more going on in media than a new Disney CEO and the possible Paramount-Warner Brothers merger. You can watch that live on Yahoo Finance or listen in on Spotify, Apple, and Amazon. Have a great weekend. Market Catalyst is next.
Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, and we are seeing some selling pressure here for the major averages. Right now, the Dow is off about more than 450 points, about 1%. We've got the S&P 500 down about 1% as well, and the Nasdaq Composite down about 1.4%. And of course, we are watching a couple of different periods of time. So let's do the S&P 500 for this. We're at the end of a week, of course, and so now we have seen this dip on the week because of selling over the last couple of days, down 1.4% for the S&P 500. I have also been watching closely the month-to-date numbers. That is the month of March, which also happens to coincide exactly with the duration of the Iran war. So over that period of time, the S&P 500 is now down by 5.6%. We have seen enormous gains in oil prices over that same period of time in the neighborhood of 40 to 50%, whether you're talking about WTI or Brent crude. So we are starting to see more pressure on stocks as a result of those higher prices. And by the way, we just got University of Michigan final March consumer sentiment. It fell to 53.3. The estimate was for 54. The March one-year inflation expectations at 3.8%. The preliminary read had been 3.4%, and it's not hard to see why. We, of course, have had these higher energy prices over the period of the month when the survey was going on. Here's to take a look at what we're seeing for the sectors in the S&P 500. This is the week here. So we've seen the most pressure actually on technology, which has really been interesting, this big rollover that we have had in tech here. So the XLK, which is infotech, down 3.3%, communication services down nearly 4%. Energy continues to be an outperformer along with materials more broadly and utilities. And then let's take a look at that monthly look here. Since the beginning of the war, what have we seen? There's only one group in the green. No surprise, it is energy, up 10% as we have seen that surge in oil prices. Everything else is in the red. Again, communication services is here, consumer discretionary, real estate, which has suffered as we've seen those bond yields go considerably higher over the past month. Tech there, industrial. So basically everything has been down, and most of these groups are either pacing or underperforming the broader market over this period of time. So now we're going into another weekend. We're continuing to watch headlines here. Oil prices, as I mentioned, are higher to end the week. President Trump giving Iran a 10-day extension to reopen the Strait of Hormuz. Looks like the market doesn't much care here. Yahoo Finance's Jake Conley and Ben Werschkel are joining me now. Ben, I want to start with you and the latest that we have gotten from the president and kind of, where things stand as we head into this weekend.
Yeah. So in terms of this 10-day pause you mentioned from President Trump, this is there's a lot of uncertainty around this. Iran is again denying that they asked for a pause. But the bottom line here is that Trump is delaying his strikes on, or at least his threats to strike Iranian energy facilities by 10 days. The new deadline is April 6th, which is about a little over 5 weeks since the conflict began. So it shows, I think it demonstrates how there's no kind of immediate off ramps to this conflict, even as Trump searches for those. We're in for another week of talks on this. This announcement from the president also does not include other strikes. The U.S. has continued to strike military targets in Iran. That was in evidence this past week, and it's expected to be in evidence for this additional 10-day pause. It also doesn't change directly the situation in the Strait of Hormuz. That's an ongoing situation. We have new details there overnight about Iran's continuous control. The shipping site Marine Traffic tracked a Chinese container ship, watched it go up to the strait, turn right around, apparently at the behest of the Iranian regime, who's in the process of kind of implementing passage for friendly, or what they call friendly countries, but also implementing fees. So at least Iran is able to say this ship can pass, this ship can't. That's an issue that Trump's going to have to deal with over these 10 days as well.
Yeah, and Jake, that really seems to be what the oil markets are very focused on, is who is getting through the strait. We've had this sort of like daily tracking of the number of ships, which was around 130 to 150 before this all happened, and now has been a half dozen or less since Iran really started choking off the access there.
Right. I think we saw 7 yesterday in total, which tells you just how small that number is compared to the 130 to 150 ships we were seeing per day beforehand. And if you look at oil markets right now, prices are on the rise this morning. They are very close to being back where they started the week, kind of before all of this will they, won't they from the Trump administration of striking Iranian power infrastructure. So I think it tells you the market is really not taking this as a sign that this conflict is going away anytime soon. Yesterday, when the president announced this delay that Ben was talking about, we saw oil prices drop immediately and then bounce pretty much right away, right back up. They're now higher than they were before. So I think the market's looking at this and saying this is not a sure thing. Iran still appears to be in control here. You saw the president talk about that gift, so-called gift, right?
Right.
Of ships passing through the strait. Those were mostly Pakistani ships going to Pakistan. We've seen oil get out to China, so this is not oil that's going to make a difference on the market, especially for US prices. And I think a lot of people are now looking at this with a lot of trepidation. You saw Macquarie come out this morning, a team led by Vikas Dwivedi, saying that if this goes through June, they're looking at oil at 200.
Right, and that's something we heard from Steve Ernsberger when we were at CERAWeek in Houston earlier in the week, which is a big energy conference. Okay, so this is what's going on with oil markets, and we're starting to finally see it take a toll on stocks, which had been sort of intermittent up till now. The other big news that we're watching, speaking of Houston, and we'll get into that in a minute, Jake and I both had some adventures getting back from Houston, but it looks like there is finally been some movement on getting the TSA funded.
Yeah, indeed. There was a significant breakthrough overnight. It happened at 2:21 a.m. to be specifically precise, which is that the Senate passed a compromise bill to end this partial shutdown for most of the Department of Homeland Security. That would fund the TSA, which has been behind all these travel problems, FEMA, the Coast Guard, departments like that. It would leave aside ICE and the Customs and Border Patrol agencies to kind of for lawmakers to fight over another day. But this would be a major breakthrough in that these agencies that have been now without funding for 41 days, TSA workers, perhaps the most publicly and dramatically impacted, would get paychecks if this goes through. This has the House of Representatives as the next stop on this. House Speaker Mike Johnson has a few ways to get this through, but it's going to be a challenge, as there's a lot of conservative Republicans who are going to be opposed to this because it doesn't fund ICE and the Customs and Border Patrol. It's worth noting that President Trump has rejected a deal along these lines for weeks now. So he signaled he'll support a compromise, but his position there isn't clear as much at this hour.
Yeah,
bottom line here, though, is that, go ahead.
I was just going to say a couple of follow-ups for you. At the same time, didn't he say he was going to sign some sort of order to get these guys paid?
Yes.
Is that possible? And where does that funding come from?
Exactly. This is kind of a backup plan of sorts that Trump announced last night. He said he would fund TSA workers, or he would direct funding for TSA workers via executive order, kind of circumventing Congress just for these TSA employees. It's unclear exactly what legal authority he would do that under. It seems to be he would take money from the one big beautiful bill that was passed and use that there. But that's a little bit uncertain. But if the House can get this through, that executive order wouldn't matter. Either way, for TSA workers, it's worth noting today is actually their payday. So this is a real sort of pressing issue for them right now, whether one of these two methods passes in the coming hours.
So if it does get passed today, could they actually get their paychecks today?
I'm not sure exactly how quickly they can do it. I'm sure that the officials would work as quickly as they could to get it through. It's worth noting that the House, the different maneuvers the House is considering here, could push this into the weekend. So it might not actually get to the president's desk by today. But it seems like it's either kind of a today issue or a this weekend issue, depending on which strategy Mike Johnson uses to try to kind of muscle this through over Republican opposition. Well,
and Ben, of course, even if they pass this for TSA funding, they still got to come back and address the issue of DHS funding, right?
Absolutely, yeah. That'll be a kind of own issue. What this also does is it increases the chance of a kind of one big beautiful bill 2.0, because basically the only way Republicans are going to be able to get through funding for ICE and the Customs and Border Patrol is on a party line vote, and reconciliation is the only way they can do that. ICE and Customs Border actually has enough money for now. A lot of that money was passed last year in the One Big Beautiful Bill 1.0, but it does improve the chances that we're going to see a kind of follow-up reconciliation bill in the months ahead, if this is the shape that goes through.
Well, and Jake, as I mentioned, this hits home for the two of us because we were just in Houston earlier this week, and I, as I relayed to our colleague Miles Udland earlier in the week, I ended up driving to Austin and taking a plane from there. You waited in that line.
I stuck it through.
What was that like? I mean, were people pretty patient?
Do you know what? I was surprised by the humanity you saw, right? Everybody was pretty patient. If there was someone who, had a walker or needed a wheelchair, everyone was pretty accommodative. I was feeling for the parents with little kids who are sitting in a 4-hour line. When I first got in line, a TSA agent handed the woman in front of me, who I became fast friends with, a paper kind of marking saying, once you get to the front, hand me this back, and then I'll be able to time out how long the line is. He said his estimate for us was 2 hours. That line was about 4.5.
Yeah.
Inside, upstairs, outside, back through, and then a maze to get through to the actual security. We made it. I made my flight. I think several people around me did not make their flights and were hurriedly trying to rebook with United. IAH, I'm sure you saw, had all of security going through 1 or 2 terminals.
Yes, there are 5 terminals
right,
there.
There are 5
were down
usually.
To 1 or 2 at various times.
TSA pre-check was closed.
Yep.
Clear was closed.
Clear, which, by the way, I had forgotten, it's a publicly traded company. The stock's been going up. I was one of the people who signed up for Clear, hoping it would help. Nope.
Nada.
Did not help because it was closed.
I heard from several people in that line who had signed up on their way to the airport for Clear, paid the $200 fee, and then found out that it was no good.
Yeah, luckily I knew ahead of time, but I had signed up before I left New York. So, well, hopefully all of this will be over very
soon.
We'll see. All right, thanks so much, Jake. Appreciate it. Glad you got back. Glad I got back. Thanks, Ben. Appreciate it. Coming up, BitGo's first earnings report since making its publicly debut. We'll be speaking to the CEO next on Market Catalysts. BitGo releasing its first earnings report since the digital infrastructure company went public in January. It's seeing revenue growth of more than 400%. That's what it saw last quarter. Mike Belshi, BitGo co-founder and CEO, is joining me now. Mike, it's good to see you. So you guys had that huge increase in revenue. You, however, posted a net loss, and that has to do at least partially, if not entirely, with what happened with crypto prices. So walk me through that loss and how investors should be thinking about it.
Well, actually, adjusted EBITDA was up, was positive. What we do maintain a little bit of Bitcoin on the balance sheet, and Bitcoin prices are down. Look, we're long-term bullish on what's going to happen with digital assets, in particular Bitcoin. So yeah, that does show up that way, but that's not, I think, the real indicative part. And also just remember, BitGo's not a digital asset treasury company. We're an operating company. We do have Bitcoin on the balance sheet. We have had it since 2014. It's been a fantastic investment for us. We're going to continue to maintain that. But obviously, when the prices there go one way, you'll see that on the net loss, but it doesn't show up on the adjusted EBITDA.
And so you guys are, seeing a lot of demand in various areas, even with what's been going on in the crypto markets, derivatives trading in particular, which you launched at the beginning of the year. You're seeing a lot of volume on that. So talk me through that business and how that accrues to revenue, and then that EBITDA number as well.
Sure. Yeah, we just launched derivatives this year. We didn't have it last year. You can see the gross revenues and trading volumes have been significantly up. So we're really happy about that. Proud of the team in terms of what they've accomplished there. This year, launching derivatives gives a much stronger trading platform. Having the number of assets and clients that we have on the platform, many of them institutional, they like being able to come to us, get the full service. We give them the trading capability, we give them the custody capability, we give them the staking capability. Of course, some borrow and lend as well in there. So all of this has contributed to kind of growing the business. Ultimately, this grows towards a prime brokerage element, which we're excited about. Overall, we're pretty pleased.
And when you are seeing those derivatives clients, I think you talked on the call a little bit about some of your spot traders moving over into derivatives. Are you seeing sort of a switching phenomenon? And or is it sort of an additional phenomenon where they're adding those kinds of services?
Well, sure. If you're familiar with how trading works, I mean, in general, derivatives, notional trading volumes are going to be significantly larger than spot trading volumes. So we expect to see some of the shift. So we didn't offer the product previously. That meant people that wanted to access derivatives had to take their assets off platform and go do it somewhere else. Now they could do it with BitGo. So some of the traders that previously were trading spot now moved to derivatives. And so we saw over 3 billion, US notional value of trading volume on derivatives just since January. And we think that number will continue to grow. We'll see exactly what the balance is between the spot and derivatives for our types of clients. But overall, we think this helps bring more clients onto the platform because we've got a much more robust trading offering.
Mike, I do want to circle back around to cryptocurrency prices, because to your point, you don't have a lot of Bitcoin on your balance sheet, but it affects, how much price action affects how much people want to trade. So how leveraged are you to crypto prices? I mean, you've seen your stock pull back, not just today, but since the IPO, along with crypto prices. So, how should investors and potential investors think about the relationship between the company and these prices?
Yeah, one of the most challenging parts is like being on this call, right? We just did our earnings. We'd like to have like the company performance stand alone from how the market is performing. And of course, the market's going down, just at the point where you're trying to show what your earnings is doing, and it conflates these two numbers, so it makes it a little bit tricky. Look, crypto is a high volatility asset. Bitcoin's high volatility. You've got to have a thesis about it for the long term. So we've been doing this for 13 years now. We're one of the early generation companies that got into the space. We've been through lots of highs and lows. It could well be that we're going to see more pain on the digital asset side. I mean, I got to feel for investors right now, not just related to digital assets, but across all sectors, in particular, technology. Definitely seeing a lot of difficulties given all the uncertainty that's going on around the world. Probably at the point where you just feel the most desperate, the most like, oh my gosh, this is going to go to zero, it's never going to come back, is when actually you'll be at the bottom, and then things start to recover a little bit. So we'll see how that goes. These things come and go with market cycles. There's also going to be another blow off top that's going to be amazing. And then everybody's going to forget about this particular piece of the pie and think about the future one. So look, you have to be in it for the long term. BitGo, we're fairly dependent upon how the prices of digital assets go up and down. So that's a reality that we face. We've got stablecoin offerings, which now start to get away from that. Trade volumes start to get away from it because they go up even when the markets are going down. But in general, yeah, we have a lot of tie to digital asset prices, but we have a very long-term view. We remain bullish. Look, I think all of this uncertainty, in the Middle East, as well as the continued deflation of the dollar, inflation of the dollar, is going to continue to prove the thesis of Bitcoin, digital assets. So it's going to come around. But yeah, sometimes it's hard on days like today.
Yes, and there's been some challenging days, but I feel you, Mike, and I appreciate you coming on and talking to us on a day when the market is doing what it's doing and your stock is sort of participating in that. I know that you have been watching the Clarity Act really closely, as has everyone in the industry. I'm curious if you can walk me through specifically what you see it potentially doing for BitGo.
Well, we've seen a huge wave of new participants in the space. Pretty much every traditional financial player has got something, and you're reading about news almost on a weekly basis. Morgan Stanley is coming in, Citigroup is coming in. I mean, just down the line, of course, we got the folks that were in previously, BlackRock and Fidelity, and all of those. So every single traditional firm is now seeing a path forward. Clarity makes it so that not only do we have the regulatory green light and acceptance that this is a real asset class, but also get that all the way through a legislated path. I know there's a lot of debates about what's going on with the interest on stablecoins. I think that these are going to turn out to be kind of a small road bump in the long history of how this unfolds. So clarity helps everybody feel like, great, we've got the legislative path. Then remember, there's like a year and a half or 2 years of work that has to still be done where the CFTC helps kind of formulate the actual regulation that we have for crypto and digital assets.
And speaking of legislation or regulation, I guess, you guys had an interesting deal earlier this week that you launched with Susquehanna Crypto, where entities or individuals that have assets on your platform can use them in prediction markets, right? Do you have any concern, or do you foresee prediction markets being regulated in a different way going forward? I know there are some members of Congress who are talking about that.
Yeah, for sure they are. There's a lot of talk about this. I think prediction markets are a very valuable tool and a reasonable investment for all kinds of things. But there's also a line where people start to say, like, wait a minute, is this overlapping with gambling? What we're doing, we're not a prediction market ourselves. We're just making a conduit where people can access them through Susquehanna. So it's an innovative cycle. It's a way that you can actually de-risk. You can now have your assets stay, at BitGo, at a national bank, where BitGo Bank and Trust, regulated by the OCC, and yet have access to those markets. So we think that this is a good safety step for what happens with prediction markets, and then regulators will figure out what the right mix is for what's allowed on the prediction markets themselves. Overall, I'm optimistic about it, though.
Mike, it's good to see you. Thanks a lot for joining us.
Thank you for having me.
Coming up, we'll bring you the top analyst calls on Wall Street and a look at some of today's trending tickers, plus the latest read on consumer sentiment. That's all next on Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the Nasdaq today here in Times Square. Let's turn now to some of today's top analyst calls we've been watching all morning on Wall Street. Today we're taking a closer look at Netflix, TripAdvisor, and the egg brand Vital Farms. First up, Oppenheimer raising its price target on Netflix to $135, up from $125. The analyst thinks that the company will see higher revenue from those price increases it announced this week. He said, quote, Netflix is showcasing why it remains a top internet platform, raising U.S. prices, get this, just 15 months after its last increase. The street is bullish on this stock. There are 49 buys, 15 holds, and no sells on the street. Next up, let's take a closer look at TripAdvisor because Bank of America upgrading the stock to buy. The analyst thinks there is a clear catalyst path for value realization boosted by activist engagement, including from Starboard Value. That activist investor took a 9% stake in July of 2025. She thinks that with the recent momentum, it increases the likelihood of strategic actions across TripAdvisor's portfolio. The street is a bit on the sidelines with this one. There are 4 buys, 9 holds, and 4 sells. Last up, let's take a look at Vital Farms. Once again, that's the premium egg and butter brand. Tells the advisory group cutting its price target on the stock to $26 from $35. The analyst thinks that given the uncertain macro environment and increased availability of specialty eggs at promotional prices is expected to put some pressure on leading brands like Vital Farms as they look to attract consumers. The analyst says that he saw sharper promotions at retailers like Costco, Trader Joe's, and the premium food brands Whole Foods. There are not 10 buys and 2 holds on the street right now, but there are no sells. Keep right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the trading session.
Now time for some of today's trending tickers. We are watching Carnival Cruise Lines, cybersecurity stocks, and Unity Software. I want to start with Carnival Cruises. This is the first of the big cruise lines to report, and the first that we're really hearing what the bite of increased fuel costs is going to be. And it's a doozy for the company. It's raising its expected fuel costs for this year to $2.15 billion. That's up by a third. And the company says it is assuming here that the purchase price of fuel for March and early April will be Brent crude averaging $90 a barrel, then for the remainder of April and May as well, and then $85 a barrel for the third quarter and $80 for the fourth quarter. So in other words, sort of doing its own futures curve, if you will, as it looks out to what it expects those fuel costs to be here. And so the company now says full year earnings will be lower than it had anticipated as a result of these higher fuel costs. If you look at the backdrop here, the company's first quarter profit was the best since 2020. So it looks like underlying demand is still relatively strong. It's that the fuel costs are really problematic for this company and probably some of its peers as well. Let's also take a look at cybersecurity stocks here. We're seeing stocks like CrowdStrike lead some of the declines, and that's after a report from Fortune that said Anthropic is testing a new AI model that has to do with cybersecurity tools, offering cybersecurity tools here, and it has powerful cybersecurity capabilities according to that article. We've been seeing this really since the advent of the generative AI LLMs, the large language models and chatbots, that when they're rumored or reported to come out with some sort of new functionality or new model, we see different areas being hit. So today it is those cybersecurity stocks turned, and all of them are down pretty sharply, but the market overall is down, of course, as well. And then finally, Unity Software, which is a gaming software company. We're watching that stock. It released a preliminary first quarter results that were ahead of its forecast here. The company is also planning to sell a video game publisher, and it's also closing an advertising unit. That is something that some analysts had been anticipating here. So those shares are higher by almost 8%, and also, of course, bucking the downtrend that we're seeing in the market overall. Take a step back here. Consumer sentiment is weakening amid the war in Iran. The latest data from the University of Michigan showing consumer sentiment falling to 53.3 in March. That's below where economists were expecting that number to come in. Meanwhile, inflation expectations are on the rise in a big way. Forward expectations for the year show consumers now see inflation hitting 3.8%. Before, they thought it was going to be 3.4%. Joining us for more, Joanne Shu, the University of Michigan's Director of the Surveys of Consumers. Joanne's also a Research Associate Professor at the Institute for Social Research. Joanne, it's great to see you here. So As you look at this number, I mean, do we just trace a lot of it back to gasoline prices? What do you blame here for this deterioration?
We really saw a strong break in the trend right around the time of the start of the military conflict in Iran. So consumers are broadly quite worried about the possible consequences of war on the economy. The primary pass-through is through gas prices. We saw an enormous fivefold surge in one-year gas price expectations. And of course, we saw that pass through to short-run inflation expectations as well. Consumers are absolutely expecting inflation to pick up in the year ahead, but at the same time, they're not necessarily expecting long-term consequences. Long-run inflation expectations only ticked up slightly starting March 1st.
Joanne, I was also intrigued here that it is consumers with middle and higher incomes that were affected in this survey, because there has been this perception, rightly or wrongly, that higher income consumers would be maybe somewhat insulated. So what was going on there?
So middle and higher income and wealth consumers might be a little bit more able to absorb high increases in gas prices. However, they're also looking at their stock portfolios, and there's been tremendous turbulence in stock markets. So they're being buffeted by two different factors: the prospect of escalating prices, as well as the turbulence, turmoil in financial markets right now. Whereas those at the bottom of the income and wealth distribution, of course, the gas prices are a much larger part of their budgets, but what's happening in the stock markets doesn't really affect them.
As always, we try and sort of figure out, is this hit to confidence going to result in a hit to spending? And historically, we haven't seen a one-to-one correlation there. But what do you see as you look at these numbers, and what could be that sort of transference, if you will?
So we are with sentiment scores in the 50s, these are not good numbers, and we've been there for quite some time. And we're already seeing some evidence of a pullback among consumer spending, right? Like GDP growth has continued to be revised down. And one of the big reasons that consumers are less willing to spend now than they were in 2022, when sentiment was around these levels, is that consumers perceive that labor markets are much weaker now, or the prospect for labor markets is much weaker now than it was a few years ago. So they remain extremely frustrated by high prices, but they're also concerned that their incomes are not as reliable as they may have been in 2022 or so. And add to that this turbulence in financial markets, in oil markets, in gas prices. So this is a lot of stress on consumers right now. And there aren't really major sources of strength for consumers to draw on at this time, particularly if stock markets continue do not return to their trend of growth that we have been seeing in recent years.
And Joanne, it bears noting here, you guys did this survey between February 17th and March 23rd. So 2/3 of the survey, you point out in the release, was completed after the start of the conflict in Iran. Historically, when we have these kinds of geopolitical conflicts that have an effect on the markets or on gasoline prices, if they conclude, how quickly does sentiment tend to rebound?
If the economic effects of whatever the conflict is dissipates quickly, then consumer sentiment is likely to recover fairly quickly as well. The most recent example that we have, Russia's invasion of Ukraine, isn't that kind of situation, right? That happened when inflation was already on the uptick, was already rising quite quickly, Russia's invasion of Ukraine put additional fuel on that fire, of course, that conflict has still continued. It hasn't abated. So I think consumers are really going to be reacting not just to the geopolitical shock itself, but really on what's happening throughout the economy. If gas prices recover, if we don't see pass-through onto overall inflation, then consumer views on this will recover. And indeed, in the last few months, we had seen consumer sentiment on a very slow and gradual uptick, which is one of the reasons why this downturn after the start of the military conflict in Iran is so striking.
Joanne, thanks a lot for your time. Appreciate it.
My pleasure.
Coming up, how one AI-powered business travel platform is navigating uncertainty. We'll be right back. Business travel and expense platform Navan hitting its first full year of positive cash flow 1 year ahead of target. Yahoo Finance's Josh Lipton spoke to the CEO.
Ariel, it is great to see you. Why don't we start, Ariel, with these earnings results, because your stock is ripping higher in today's trade. Your revenue up about 35%. Your gross booking volume up about 40%, Ariel. I'm just curious, how are you delivering that kind of strong performance, Ariel, against a backdrop where I think a lot of investors, they might have assumed, listen, this has got to be tough for a travel platform, war, TSA chaos. Walk us through it, Ariel. How are you navigating this?
Yeah, first of all, thank you for having me. I'm excited to be here and basically telling our story. And just to take a step back, Navan is a platform that is basically doing fundamentally two things. For companies that are employing employees that travel, we save 15% on their entire travel budget. So if they're spending $100 million on travel a year, they will spend 85 with us. So that's significant, especially in times like this with a lot of economic uncertainty. But more importantly, for the employees, for the travelers, for the executive assistants, we know how to help them really easily when they're on the road using AI. So all of these interruptions that you see, the Middle East, we had two major storms during this Q4 that we've just reported our earnings. Obviously, TSA lines right now. All of these things together, the Navan platform is actually designed to support you in these situations. And therefore, as a traveler, you're actually becoming more loyal to us in times like this. And you can actually see it with our growth rate and our numbers.
What are corporate clients, Ariel? I'm curious. What are they asking you for the most right now? Do you have line of sight there? Like, is it rerouting? Is it, listen, I got to change my itinerary last minute? Is it cost control? What do you see?
It's both. So first of all, when you go to our system and you're a day before the trip, the system will tell you it's raining right now in New York and it will take you longer to get to the airport. But then the TSA line right now looks like this. And by the way, if you have clear, it will look like that. So we are giving you all of this information, which is really, really important, not just about saving time, but business trips are important. These days, they're even important more than ever because you need to meet your goals. It's your sales team that are going out there and closing the deal. It's the C-level that are making sure that the company is okay. It's the business development. So this is really, really important now more than ever. On the other side, you have all of these interruptions. So our ability to tell you up front, take an extra 30 minutes when you go to the airport, or if something happened, we're going to support you. And we are supporting you in seconds. Just to give you an idea, during the two storms in New York, 55% of our support was done by AI with 85% satisfaction, which means that you are really happy with that. And this is with an alternative to wait for hours on the line waiting to get service when there is an event like a storm. So companies care about cost, but they also care about their employees' time and mainly about their employees' performance. They don't want their sales team to spend a lot of time on the line figuring out how to change a flight.
Ariel, do you see any evidence in your business, on your platform, of companies pulling back on travel, Ariel?
No, we actually don't see that. And again, you can see it from our reports. We grew the bookings, GBV, on our platform in Q4 by 42%. This gives you a good idea of usage. We also have a good idea of what's going on right now. We see a lot of changes, more than usual. So definitely a lot of people will change their trip a day before, a day after, 2 hours later, I've missed my flight. But we don't see any cutback on travel budgets or travel at all.
We hear a lot, Ariel, increasingly of airlines, and you've heard this, they're emphasizing premium features, premium experiences. How does that benefit your business?
This is actually really important. We view travel as something that is universal. It is relevant in the business work. It's relevant be leisure. This is when people are combining their business trip with their personal trip. Is an extremely strong use case for us, and it's growing, which tells you that people have more time to also invest in themselves, which basically tells us that as people are kind of experiencing the world. Travel is a really important part for them. And Navan is a really big part of that experience. And for us, experience is planning the trip, everything that is happening when you are on the road, including we recently announced that you can book restaurants with our platform. And when you're coming back, you can automatically expense your trip. So we really care about every step, making sure that you can actually focus on being there, on the experience, on meeting customers, being in your vacation, and not with all of the hardship that usually comes with travel.
You mentioned AI, Ariel, and you're an AI first company. Your AI assistant, Ava. I'm curious, walk me through one, how does Ava improve the customer experience, Ariel, but also how does it make your own company more efficient?
Yeah, so first of all, everything that we do, we walk it back from the customer, from the traveler. So when we introduced the chatbot, it was important for us that it will not be, we are all familiar with these chatbots that you are kind of yelling representative like a madman. That's not what we wanted to do. We wanted to do something that is smooth, that supports you in something that is super emotional and super stressful, which is travel, which means that we had this ability to orchestrate AI agents, which are basically done everything automatically, very fast, but also with people, with real life agents. And sometimes it will be behind the scenes and you're still talking with Ava. Sometimes Ava will actually transfer you to an agent. And the reason is that there is no such thing in the complexity of travel as just an AI agent. But when you augment the two and you orchestrate it perfectly, you are providing really good and fast service to our travelers.
Ariel, you do have competition, including some big names, and I'm curious what you think gives you the competitive edge.
I think it's a lot of different things. The first thing is that we are definitely creating massive savings for customers that are using us. So that's really, really important. But the second thing, and we actually reported for the first time our churn number. We have 98% retention, and this is for years. It means that once you started to use Navan, you'll never stop using it. It means that people love our system. Our NPS, this is the satisfaction of people from our platform, is 47. This is really high. So we are obsessing about the customer. We are obsessing about the travelers. And that's why we win. We reported in Q4 that our net new sales, these are new companies that are coming to the system, grew by 50% compared to Q4 last year. This means that we are really taking a lot of share from our competitors.
Yeah, all 13 analysts, I'm just looking here, all 13 analysts on Wall Street who cover your company, all 13 have a buy. 0 holds, 0 sells. Not bad, Ariel. Thanks for your time today. Appreciate it.
Thank you so much.
Coming up, being selective with portfolio management during times of uncertainty like right now. We'll be right back. Portfolio positioning during geopolitical turmoil is hot on investors' minds. Let's delve into how to manage them. Joining me now, Matt Powers, Managing Partner at Power Advisory Group for this week's FA Quarter, brought to you by Capital Group. Good to see you, Matt.
Hey, Julie. Good morning.
So let's talk about what's been going on and sort of what you've been hearing from your clients, how people are feeling over the last month during this war as we've seen this volatility come into the market.
Yeah. I think the best way to think about this market right now, it's really not necessarily about earnings for once. It's not about the Fed. It's about oil. And, we've clearly shifted into a market that's being driven by geopolitics and energy, like you said, and very different situation than what investors were dealing with a month ago. And, we've got oil back above 100 and it just touched 110, which I didn't think I'd ever say that, but it's not just a headline here. It's feeding into inflation. It's pushing rate expectations. It's driving all this volatility every day. And, we're touching bear market territory for the Dow and the Nasdaq, I think today, actually. So I'm not going to pretend I'm an expert on the Strait of Hormuz. I don't think any of us necessarily are, but, we know where it's coming from. You got about a fifth of the world's oil supplies in jeopardy right now. So I think the cleanest way to frame this is there's two paths from here. So this is what we're telling clients. One, this resolves relatively quickly. Shipping normalizes, oil comes down. The market probably snaps back. In that scenario, you definitely don't want to be sitting on the sideline. But the other is that this just drags on, and that's where it's becoming a real macro issue. I mean, you'll start thinking about higher inflation and slower growth, and I hate even saying stagflation, but that type of setup. And I don't think the market's fully pricing all that in yet.
Yeah, and we got a taste of this in the University of Michigan sentiment report that just came out and showed, people aren't feeling great about how they're doing right now, and they're expecting higher inflation. So let's talk about what you tell people, because there's not been a lot of places that have outperformed here, except maybe for energy stocks. But I know that you're looking at places like defense stocks right now as maybe a place to look at. Why?
Yeah, I mean, it's not a play on words here, but you want to be a little more defensive, I think, with portfolio positioning and less offense here. So to me, I think we're looking at a shift in leadership and positioning. We saw the broadening when we started the year, and prior to everything happening with Iran, that was continuing. But I think the approach is just you stay invested, but you just get more selective. So defense, you brought that up. It makes sense here. I mean, not just because of this conflict necessarily, but we're in a multi-year global spending cycle, and we like defense before this, we like them now. Demand's stable, and spending is not going to slow anytime soon. That's clear. So you can look at Raytheon, Lockheed Martin, two companies we like, both dividend growers, which we love. But Raytheon's it's a broad-based play across aerospace and defense, and they've got a big backlog, so you've got some good visibility there. And then Lockheed's, they're the gold standard in missile defense. So super consistent dividend and really predictable cash flow. So we like that. We like staples. You can throw in your standard Procter & Gamble, Pepsi, Costco is a little bit of a growth play there. And then, I think the underappreciated piece here is cybersecurity. So if this escalates and we stay on that subject, the battlefield here is not just going to be physical. I think you're going to see some digital, and spending there doesn't get cut. It's going to accelerate. And we like CrowdStrike and Palo Alto. CrowdStrike, it's the leader in endpoint security, and they're growing through acquisitions, very strong. And Palo Alto is more of a total platform play, and they cover a pretty broad range. So if we lump all that together, it's a good way to stay invested, but being a little more selective and a little more defensive with the portfolio.
I do want to dig into staples a little bit, because that's an interesting one. It caught my attention earlier this year because early out of the gate, it was one of the best performing groups this year. Since then, it's not. It's still up on the year, but it's not in the top spot anymore. And I wonder if that group is particularly vulnerable at a time like this, a time of inflation, right? Because their costs are going to be going up. We know, to ship things around, the cost of diesel and things like jet fuel are going higher. But also, are people going to be, maybe trading down to generics, for example, or store brands at this time?
Yeah, with defense, it eventually, high oil prices, it's going to trickle down. Inflationary pressures eventually hit the consumer. We know that. But, I think so far this year, they're kind of middle of the pack as for performance as a sector. And yes, they did have a strong start to the year, but kind of peeled back. In the past few years, they've been completely out of favor, with AI kind of leading the way. But, what we like with staples, I mean, regardless of really what's happening in the macro, they do have some pricing power there. And we're a dividend growth type firm, and we like that side of it. We like dividend growers right now, so very specifically. And we maybe the past year or two, certainly underperformance, but lower volatility. And it's you get a lot of very, like with Procter and Gamble, very strong, consistent cash flow. And we just think those are, a company like that's an area that you want to, about as steady as it gets, where you want to be placed if you want to stay equity invested. Pepsi's kind of in the same boat, well diversified, more so than Coke, and it's a good way to dampen volatility.
Yes, and dampening volatility is definitely something that people are interested in doing right now.
Absolutely.
Ned, good to see you. Have a great weekend.
Yeah, you too. Good to see you. Thanks.
That was FA Corner, brought to you by Capital Group. And that does it for me and for Market Catalyst. Have a great weekend, everybody. More Yahoo Finance is coming your way.